Hey guys, it's Sasha. Stock prices of AI companies have exploded in the last year and a half since ChatGPT launched in November 2022. Remember that by November 2022, AMC had already lost 75% of its share price after the short squeeze didn't do no squeezing. Peloton stock was down 94% after people realized that $3,000 is a bit too much to pay for a coat hanger. Floki Inu did not, in fact, replace the US dollar as the global reserve currency and lost 97% of its value, and it turned out that a URL of a picture of a monkey wearing a funny hat is in fact not worth $300,000. So investors were jubilant when there was a brand new, obvious opportunity that this time was definitely 100% going to the moon with AI in November 2022. Since that date, Nvidia stock is up 350%, with the chart going vertical in 2024. This of course looks completely normal. Microsoft stock is up 63%. OpenAI went from being a company most people had never heard of to an $80 billion valuation at the funding round that closed last week, and more recently Palantir shares went up 47% immediately after they mentioned the word AI, a record 61 times on their Q4 earnings call. And the latest hottest ticket in town is Super Microcomputer, that make cloud server equipment that apparently is good for AI. So the stock went up 220% in 3 weeks at the start of this year, which is also completely normal. Some analysts have speculated that this explosion in stock prices of AI companies by hundreds of percent in just a few weeks or a few months looks like a typical bubble. But of course, you know that on this channel, we don't listen to the naysayers who dare spread FUD about a favorite vertical line stonks. And the most popular one of these at the moment is Nvidia. Nvidia was in the right place at the right time when the AI hype train arrived at the station. They sold the best graphics cards just as investors and large tech companies learned that you happen to need thousands upon thousands of those really expensive graphics cards in order to do AI. The cards that had a sticker price of $8,000 were so in demand that Nvidia started selling them for $35,000 a piece. And the buyers just kept on buying. Microsoft and Meta each apparently bought $4.5 billion worth of cards from Nvidia in 2023. Google, Amazon, and an army of other tech companies have been buying as many graphics cards as Nvidia can sell, and these sales alone added up to more than double Nvidia's total revenue from back in 2019. As a result, Nvidia's revenue has increased by 200% year on year, and because operating costs remain relatively flat, the net profit is up 1,260% at $9.2 billion. The expectation is that Q4 numbers that will be announced later this week will be even better. After the recent run-up, Nvidia's market cap is now sitting at $1.8 trillion, and using these latest profit numbers, Nvidia has a PE ratio of 50 and a price to sales ratio of 25. So the current valuation of Nvidia assumes that the company will keep on growing from this boom in AI chip sales at a pretty fast pace to justify the current valuation. Now, in March 2000, there was another company that was making hardware for the dot-com boom. That company was Cisco. In the 2000 financial year, Cisco's revenue grew 55%, and the high demand meant that they increased prices of their hardware to a point where their gross margin for the year was 66%. Nvidia's gross margin at the moment has increased from 54 to 74% in the last 12 months. And back in 2000, Cisco's valuation went to the moon with a vertical line to a market cap of $555 billion, because you see, the internet was the big new thing. And Cisco was by far the market leader in selling the hardware for this new cool tech innovation that was going to absolutely change the world. The age of the internet was the new gold rush, and Cisco was at the bottom of the mountain selling the very expensive shovels. And the thing is, Cisco actually did pretty well afterwards. Since 2000, Cisco's revenue and net income have both increased by 200%. The problem is that an increase of 200% in 23 years was a bit less than what the stock market was expecting when they were valuing the company in 2000, because the stock market was buying Cisco stock at a price to earnings ratio of 201 and a price to sales ratio of 31. So Cisco's stock price collapsed by 87% from its peak, and it turned out that after a lot of people bought the initial hardware, well, sales stopped growing anywhere near as fast because there was a physical cap on how much of that hardware companies actually needed. Internet also evolved very fast, and so did the hardware, which meant that although Cisco was leading the way in 2000 and the hardware was mighty expensive, both of those two things changed. They were seemingly streets ahead of anyone else, but as new technology emerged, competitors turned up, and the price of the chips went down, their market share was eroded. The big problem for Cisco shareholders was that after the company already saw a huge amount of growth, the valuation just assumed that this growth would keep on growing with no limit. And it's interesting when you draw the parallels because the similarities are somewhat striking. Retail investors and Wall Street analysts are looking at the growth that AI stocks like Nvidia have seen, and the valuation models today seem to take that growth rate and just extrapolate it in a straight line to infinity. But what happens if Google, Microsoft, and Facebook have bought enough GPUs at some point that satisfy their immediate needs for generative AI models? What happens if the quality of the chips improves so much that you just don't need as many in order to achieve all of your goals? What happens if there isn't a queue round the block for these cards as production increases and the price has to come down along with the gross margins? What happens if competitors like AMD or others start producing compelling products themselves that begin eating into Nvidia's current monopoly in the space? And what happens as AI develops over time? Because today, all the rage is on generative models. Large language models like ChatGPT, the new generative video models like Sora and others. What if AI begins going down the route of inference, begins going down the route of other general AI, whatever, which requires a, say, fundamentally different type of compute, a different set of processors that are required, and suddenly, say, AMD chips or ARM chips or some other chips are much better suited for the task? Even if AI becomes a dominant technology of the future, like the internet did since the 1990s, and it probably will, that does not necessarily mean that the biggest companies in the space at the start end up being the biggest winners in the long run. Because for every Google, there was an AOL and a dozen others, and for every Facebook, there was a MySpace. The valuations of AI companies in the US have exploded so fast that the 7 big tech stocks have been responsible for more than 100% of the returns of the entire stock market in 2023 and so far in 2024. The valuation of Microsoft at the moment is around $3 trillion, which is roughly equivalent to the valuation of all 1,900 companies listed on the London Stock Exchange. And this creates a very unique situation where the owners of index funds like the S&P 500 carry a higher risk of the AI bubble pops than people who own the other 490 odd stocks that are not the big AI plays. Because after the stock market dived 25% in 2022, the majority of the stocks have not recovered since, because the big 7 stocks combined make up 29% of the S&P 500. And here I did a bit of simple maths. I went and looked up the performance of each of these big stocks in 2023, and I then went and got their rough weights. I just looked up the current number, their weights in the S&P 500. I'm not trying to be perfectly accurate here and weighted across the year, blah, blah, blah. I'm also not counting the dividends here, in case you're wondering, but if you multiply the return in the year by the weight, you get a rough approximation of how much each stock contributed to the S&P 500's annual return. So Microsoft by itself made the S&P 500 altogether go up 3.9% last year. And Nvidia made the S&P 500 index go up 8.5% all by itself. So if you add those up, those 7 stocks contributed 27.1% of the S&P 500's returns last year, and the S&P 500 in total returned 23.7%. And a little bit of that difference will be made up by dividends because those big tech stocks mostly don't pay dividends. But this is the crazy thing. The stock market overall made a 23.7% return last year, but the 493 companies that are not AI hype tech stocks, well, some of them still are, but the majority of them are not, had a negative return on average. So what happens if there is an AI hype crash? What happens if earnings growth slows down over the next few quarters, doesn't go to the moon and keep going to the moon forever, or people begin wondering whether the huge valuations are actually fair? Well, we might have a bit of a problem if this affects the big tech stocks, because just like the big tech stocks dragged the whole stock market up in 2023, if we see a crash in their valuations, they will have the same big effect on the way down. But remember that the other 493 stocks in the S&P 500 have on average still not recovered from the 2022 crash. And when the tech stocks dragged upwards, they did not pull all these other stocks with them. They just left them at the bottom. The focus of investors does remain very narrowly focused on those stocks. If you read the media, if you listen to finance channels, if you read about finance on social media, that's all anyone talks about. So you could perhaps put forward an argument that if there was a crash specifically relating to the valuations of AI companies, the same may be true in reverse. And if anything, there may be a redistribution effect as investors in these falling stocks decide to move into other positions. Now, unfortunately, with these types of bubbles, the FOMO effect means that a lot of investors have been jumping into the stocks at the very high valuations after the stock price has already gone up for no reason other than, well, the fact that it's gone up a lot, because that's how people tend to make their decisions. Nobody cared much at all about Nvidia back in 2021 when the stock was trading at $130, split adjusted, but suddenly everyone is busy buying the stock now at $700. You see, fund managers and financial influencers, they're all tripping over each other to add Nvidia to their portfolios after it's gone up, because humans have a massive recency bias and a natural tendency to extrapolate trends. So humans see a stock that's going up in a straight line and people don't want to miss the train. So everyone loads up. Everyone loading up adds to the upward price movement because everyone's buying to a point where the company is projected to grow at 30 or 50% a year every single year between now and infinity to justify the valuation. And sometimes those investors will be right. There are plenty of examples through history of meteoric rises of companies which then did sustain into the long term. We've seen that before. But many times, a lot more often in fact, the reverse happens and the bubble ends up popping. And all of the investors then sell at a big loss and move into whatever the next hot thing is, because patience is for losers and you must make 300% per year on the next big thing, going to the moon 100% definitely for sure, or have fun staying poor.